Now, if you look at where we are right now, price-wise, it's 4,100. In regular trading hours, this is the gap between yesterday's trading up here, down here. So what I'm watching now is what we do once we go, now we're below the new week opening gap. Typically what will happen is it'll accumulate here, run back up, and start to work inside this gap. So I'm looking for that type of event in here. Not that I'm seeing it here. I'm looking for that type of signature. Like I was explaining yesterday, I was outlining the lows, how they were suspect, and I was looking at SMT divergence, and I taught you real time the dollar index failing to make a higher high, while ES was making that lower low, NASDAQ was making the lower low, and Dow was making lower low. And I called that turning point. I gave you a very specific, we weren't not lost in price action yesterday. Goobers. We were specifically aiming at that breaker. I was teaching you how to use it, how to frame it, how the candles would respect it. The wicks are allowed to trade outside of it. That's fine. So now think about what we've seen here. The session has opened up. This is all electronic trading so far from the 9:30 opening. Short sellers have sold. And where's their stop loss at? Right here. Right above here. So generally, the chase price, when it's a big move like this down, it's quick to punish those individuals that do that. And you see traders that are real quick to trade in the first couple minutes of trading. I am not a fan of that. I don't like that, because this is the usual procedure that takes place. Retail sees it. They say, oh, wow, it's really down so far. Let's go short. So when they go short, the traders that do use a stop are going to do what? They're going to put it right at the highest high that's printing on their charts, which is right here. So what you want to do is, on your chart with TradingView or otherwise, you want to use the high that's formed on the opening range that's formed thus far up to the closing price, and you want to extend that to the right. And you want to use something that's more friendly on the eye, because this is a little too much. Okay, so what I'm looking at when I do that, when I drop back into electronic trading, I have that range on my chart for you to see it. So that means all of that could be potentially challenged intraday, digging up into that. I'm not suggesting we're going to go all the way back up there, but at least for the morning session, trading the opening range, which is the first 30 minutes of trading after 9:30, so 9:30 to 10. And there's the buy stop getting tripped on retail after taking out our new week opening gap low down here. So does that sound like we're lost in price action? We're lost in love, okay? We know what we're looking for. So anyway, all through here, we want to see, does price want to go above that? Does it want to explore all of that opening range gap? Because that's what we're referring to this as. When we see a gap at 9:30, the opening range gap is the difference between yesterday's trading close to 9:30's opening price. So opening range gap, for your notes, that's what we're referring to here. That is not new day opening gap. That's not new week opening gap. So now we have this candle here. You want to be watching this. If we have a willingness to want to go above it, that's a breaker. Because we have tongue twister. Because we have this low here, and then a lower low that we went through on our new week opening gaps low. We went down below it. Now we traded back above where I told you the retail buy stops would be. Did you see a depth of market chart shown here? Did I reference any of that? No. We're looking at what the chart's going to tell you. The simple open, high, low, and close. But because we have moved so far, so far from yesterday's close, and now we're opening where we are now, the opening range gap, when it's this big, it makes the very first half an hour, 45 minutes very tricky. So I treat it much like when we have a big range day, like say we have a afternoon session run that just explodes and whether it's going up or down, that matters not. But if there's a big range, a very large range day yesterday, the morning session can be tricky. It can be choppy. It can go back and forth. Take out buy side, take out sell side, take out buy side, take out sell side. And then later on, when's that? It could be right before lunch in New York time, around 11 o'clock or thereabouts. Then it'll start a run that generally goes under the radar of most retail traders. They don't see it when it starts. And then the afternoon will be a better trading opportunity. So what I like to do is I sacrifice this morning session and I lean heavily on the 1:30 to 4 o'clock time period in the day, because if it's going to trade back up inside of this shaded area here that I have in gray, that's a lot of range. I'm not making the case it's going to go all the way back up there, at least not right away. But it's something that the market will likely want to consider revisiting, unless, now this is the only way it would be negated, if we just crashed. I'm not saying we're crashing, but I'm saying if it were to just completely fall out of bed and just find no traction at all and just want to go lower, then this type of range that's shaded in gray would just not even be considered. It would just be a breakaway gap. So we want to look at this fair value gap here. That's the next premium level. Okay, so we came back down to consequent encroachment of the new week opening gap, which also is a order block with a fair value gap. So we want to see, does it have the willingness to want to go above the short-term high? If it does, watch and see how we react inside this fair value gap. If we were to trade up through it and act as support, that would take us back up into the previous week's new week opening gap low. We would aim for something like that. You should not be pressing the button this morning. Some of you already went nuts and got drunk on Twitter this morning based on what I shared. Touching the new week opening gap high. So I'm going to take this shaded area off. You understand on your charts, this is what you should have as a visual reference to the difference between where we were yesterday at close and opening today. So already, right away, you can see the first 20 minutes or so, it's doing what? Aimless, listless trading. The only thing it's done so far is the two things I told you it would do. Go down, sweep the new week opening gap low, revert back to what? The buy stops above the intraday high, because traders are doing what? They're seeing that it's gapped down. So right away, they're fearful they're going to miss something, right? I'm afraid I've got to get in here and do something. And they plunge headlong into the marketplace trying to be short. So they use their due diligence. They want to protect their position, right? They read all the books. They're short, and they put their stop loss in a protective capacity in the form of a buy stop above this high. It gravitated right to that, like I mentioned. We went back down to consequent encroachment, new week opening gap, the new week opening gap's high, and now we're showing the bodies respecting that breaker again. That signature is what you want to see, and we've already seen it try to make an attempt. I want to see it go through this high here. I'm not interested in the 41.13 level anymore. It's already done its job now, so I'll take that off the chart. That was your draw on liquidity for pre-market. So think of that pink area up here as like a magnet, okay? And price, every new tick in price that moves up and down, imagine those being paper clips, okay? And the magnet is sitting right here in this shaded area. So if you throw a whole bunch of paper clips at a desk where a magnet's sitting, where's the paper clips going to go? They're going to cluster around the magnet or within its magnetic field. And that's the analogy I like to use when I'm teaching my sons or new students. Much like everything else I've used, I have 1,000 analogies, I know. It's the teacher in me, I can't help myself. But it makes a lot of sense that, if you were watching every new tick fall into the marketplace, okay, every time there's a new tick in price, where price is going is your number one goal right now as a new student, or if you're a trader that's struggling break even or never made profit because you don't know where price is likely to go and you can't figure it out. You can't ascertain a consistent approach to reading price, which lends well to analysis and trade setups and entry and targets and stops. Before you get into all those details, which is where you think you should be at right now, you need to understand what makes price go where it should go next. It's one, buy side. So for folks that have trailed their stop loss, that's short. Give me one second. I gotta make this line obsessive. I'm sorry. So buy side here. So what's occurring and why that's even being referred to is the market has dropped pre-market, which we were looking for. We called all that on Twitter. The movement here is a consolidation, and once it started breaking lower, everyone that was fortunate enough to be short, they have rushed their stop loss right above these relative equal highs because they see this as what? Retail sees that as resistance. So they're going to jam their protective buy stop on their short positions, hoping that it goes to Hades today. And because their stop loss is sitting here, and I explained to you where the retail will be placing their stop here for those that just watch the opening value and see that it's on CNBC saying it's really down today, blah, blah, blah. So retail's going to do what? They're going to chase and dogpile in on doing what? Short. They want to chase it going lower. So because I'm teaching you, because we had a big event before 9:30, before the opening session at 9:30 and the ringing of the opening bell in the stock market, that sets the stage for what you're seeing here. Choppy, listless price action. It denies them immediate continuation on the downside, and it runs against those individuals that have already been profitable and still hold a position in the marketplace. So open float is the liquidity resting above here, and the imbalance in here, that's not liquidity, that is going to be engineered liquidity later on. So this is inefficiency. So you have two things here lending for why it should, if it's not going to go lower, and if it doesn't stay in a small range like we see here, where is the money? The money is trailed above the recent highs, which we've seen it run here, with that run here, here, and here. What I'm watching is it was interesting to see it not get above these right here with this little spike up. And we're just hanging around inside that breaker still. So when I'm teaching you like this, I'm telling you where the market's going to be problematic, when it's going to be choppy, when it's going to be range bound. And none of the books I've ever purchased, none of the courses I ever looked at, purchased, was shared with me. All of those things that are available out there, they never really adequately talked about how to avoid these problem areas. They just made excuses for, well, sometimes it's just random price action. It's not random. You can predict when these things are going to occur, which is what you want to learn how to do, because you will learn that these are the very conditions that you blow your account in. You'll get frustrated. You think everything's a turning point. Oh, I was wrong there. Now it's turning the other direction. Oh, I got wrong there too. I mean, reverse, it's going the other direction. And before you know it, you got 70 trades on for the day. You've blown your account. The commissions end up taking you to a point where you have literally nothing to even start with the next day. And you feel demoralized. Simply because you don't know how to identify where the market's going to be very, very uncooperative. Touching the new week opening gap high again. So here we are meandering around. We went back up and touched that breaker. I want to see it erode all the way through this and get back on the upside of it. Not because I want to be right, not because I want to take a trade, is I want to see it move away from the consequent encroachment of the new week opening gap. Look at the bodies respecting the low of the fair value gap. Now we're back down into this bullish breaker. If we lose it now, if we trade below it, because we have gone up into an area that had my interest this morning, this to me, this running up here into this area here, is much more meaningful. And it is in some ways allowing for, if it were to break below this breaker and act as resistance, then we could explore lower lows. But notice when I was giving you the commentary earlier, I would have favored this here, running a buy side and going into this area here, because what would be the mechanics behind that and why it is noteworthy for me. And don't worry, I'll come back to the conversation I was having a moment ago. The buy stops here. If the market trades there and goes up in this area here, we're at a short-term premium. So if we were to lose this bullish breaker, which is shaded here, and trade down below it and act as resistance, that becomes a potential catalyst for lower prices on the day. But notice that it had to trade to a premium, and I'm not saying it's going to go down here, but to me, it would be worthwhile to see this very thing happening here versus just opening at 9:30 and just cascading lower. You follow what I'm saying? Meaning that everyone else just wanted to go short rate from Jump Street right at 9:30. And at 9:30, they gave them that little cookie, made them feel like they were on the right side of the marketplace, and allowing them to put what? Buy stops here. Also, anyone that didn't trail their stop loss here while being short early on, now they have their stop here and here. So there's two pools of liquidity with an imbalance shaded in this area here. So if it were to go lower, okay, it would be better for you to wait. If you were trying to go short or looking for a reason to be short, it would be better for you to wait for buy side to be taken out, like it's been done here, and trade up in this inefficiency, and then judge what price is done after that. Has it sold off since it hit that? Yes. Did the breaker respect it? Or I'm sorry, did the price respect that breaker? It has. We're back inside that fair value gap that's shaded in pink. So we would not want to see it show, support in this. The PD array, which is the breaker itself, this candle here. It's not simply this old high, draw a line out, resistance, broken, turn, support. We're looking at how does it react when it gets there, and you're constantly weighing that. Does price respect these PD arrays? And since it's respecting it, you don't want to hold on to the idea, okay, now if you were thinking about going short, my method teaches you'd have to see that breaker be broken and then come back up to it and act as what? Then resistance. You can't just simply say, oh, we have a fair value gap, let's go short here and expect it to run out these relative equal lows. There's a logic that's being taught to you. You have to see certain things to qualify whether or not something should be there. And we have such a large gap from yesterday's close to where we opened this morning. This entire fair value gap, we were at now consequent encroachment of that. It should expand up into the high end of it. And if we run through it, come back down and touch that support, it may act as a catalyst or springboard to take us up into closing in the small little remaining balance of this fair value gap and then up into here, which would be what? The previous week's new week opening gap low. And it would be digging up into the difference between Friday's closing price and where we opened at 9:30. There we are, we pierced through that fair value gap. So now you want to watch. So we have that tiny little remaining portion there. And yes, we've already talked about how one tick is enough. That I'd like to see it run through that pretty quickly, not just tap it. But then we turn back to the old previous week's new week opening gap low. So we opened up at 9:30 with a large gap lower. We saw price trade from that opening gap here, small little rally up, drop down into new week opening gap low, setting the stage for buy side to be placed above the short-term high. And then we also see these relative equal highs. So wherever there's a market area that is too smooth Okay, that means lows are relatively the same or highs are relatively the same. That looks like a ceiling. Okay, whenever that's like that, that smooth edge is likely to be made jagged. That means it's going to tear through that, upset that smoothness. We've seen that here. The market came down into our bullish breaker. I mentioned that if it were to go lower, it would need to go through the breaker, come back up and act as resistance. Did it do that? No. It respected the breaker. So now price goes higher. What actually happens after that? This down close candle that trades into the bullish breaker does what? Becomes a bullish order block. That candle's high, 41.14 and a quarter, becomes the low of this candle here, 41.14 and a quarter. So what we're seeing is a bullish breaker supports price, it repels it. Yes. Does this down close candle support price here? Yes. We dig up and through, which is why I said I want to see it trade to the upper end of this pink shaded area. That in itself, from here to the top of that fair value gap there, that's a 5-handle run, just with the logic I showed you there. That's a trade idea. That's a setup that could have been utilized for you as a engagement. Go back into your own charts and log that as an example of watching where it delivers there. I mean, I walked you through it real time when it was there. But this also, this trade down here, when we turn back to the breaker, see, this is what you're familiar with. This is how I teach it on my YouTube channel. Here's the breaker. It needs to leave it and then come back down into it. That's your classic ICT bullish breaker entry. That's a setup. That's a setup. Targeting is consequent encroachment in the high end of the fair value gap. Where's there 5 handles and all that? That's for you to determine and look for that going forward. If it doesn't make any, we talked about how that trailed stop loss idea on shorts here and here would be the target after it traded down into here. When it was trading right here, I said we want to watch and see. Now, because we hit our objective, the levels I've taught you, which is the new week opening gap, the algorithm reprices down there, just like I talked about yesterday. When we were not lost in price action, I told you we swept the lows. Now we're going to take it up to the buy side. There was no changing of gears. There was no another different view. It was we were going higher. I gave you that again right here on a 1-minute basis. Told you it was going to go here, and then I'd like to see it sweep here, and then go up into this fair value gap. There's several 5-handle and now forming potentially a 10-handle run that you've sat here with me. I've given you all the things that you would look for, but you're talking too much. Go back and show me what's going on right now. The order block was supported here. Price ran to the top end of the fair value gap. Then we traded back down to what? The low end of this SIBI. So this candle's high, 41.16 even. We trade down to that and 1 tick lower, which is 41.15.75, 1 tick lower. Remember what I taught you about the wicks? That's where the damage is done. The bodies of the candles are going to be telling you the narrative, the story. We trade back down, dig into what? The low end of the fair value gap, which is this candle specifically right here. Okay, this down close candle. These 2 consecutive down close candles, while this was a bullish order block here, when there's 2 of them consecutively, if we trade away from it, you have to refer to that as the order block as well. It's all one consecutive change in the state of delivery. Meaning what? That opening price is going to be highly sensitive. If we are bullish, the market trades down to it here, and it's coupled with what? The low of the fair value gap that I drew your attention to well before it even formed, or not formed, but before it was drawn up into. So this is in itself what? What is this? It's 3 things. This low trading to this is a low on a fair value gap, while order flow is bullish. It's also an order block, a bullish order block, and it's a mitigation block. What is that? Well, it's the opposite of a breaker. A breaker is where you have a low, high, lower low. And when price comes back down into it, it's typically going to support price and send it higher. A mitigation block is where you have a low, high, a higher low, and when it trades back down into that, it'll support price as well, if your narrative is correct. If you're assuming price is bullish, and every other previous thing we've shown here, all these signatures are qualifying what? Bullish order flow. So from here to this high here, that run, 5 handles from a discount to external range liquidity, which would be buy side liquidity right here. Think of this high being the same thing I outlined over here. Someone went short here. I don't care to know how many contracts they are holding. I don't care who it is. If the market dropped, someone chased it. So they're going to place a stop loss above that in the form of what? Buy stops. So you can look at this as an ideal entry as a short-term trader intraday, scalping. You could be a buyer here, and your limit order would be right at that candle's high. As soon as it went through it here, you would have taken profit. Much in the same way, you could be a buyer down here. As soon as this candle hits it, it's scary because you haven't done it before. It's scary because you don't know how to read this stuff live, but you're seeing it can be done. No scared fearing of doing it wrong. You hear me stuttering because I think I'm going to be wrong? No. This is old hat to me, and it will be old hat to you too. So here's that next draw on liquidity we're looking for. The small little micro separation between this candle's low and that candle's high.